And we are live from France to the world. Welcome to the JDC podcast, where we welcome builders, contributors, founders, the architects of distributed systems and decentralized finance. I'm your host, Sam, and in today's episode, I'm with Logan Jastrzębski, who is the co-founder and managing partner of Frictionless Capital, but also a seasoned podcaster, running a channel that I've been following for a while. Logan, very happy to have you on the show. How are you doing?
I'm doing great, and thank you so much for inviting me, Sam. I really appreciative that you said hello when we bumped into each other initially in Portugal.
It's a podcaster interviewing another podcaster. It's quite a funny situation here. I'll start with this very common question. How did you end up in crypto, basically, getting involved in that space? What happened? Could you tell us more about that?
Yeah, happy to. So I started, I think most people kind of get involved in crypto during the bull cycles. So I got involved in the 2017 run up. I was in college studying computer science and informatics. My younger brother got into crypto in the beginning of 2017 and was telling me about Ethereum and these different tokens that he was buying and how they're all just going up very quickly. And I was like, this is dumb. This is a Ponzi. Obviously, like, you're going to lose a fuck ton of money, or apologies, a lot of money. And so I kind of ignored him for the most of 2017. And towards the end, I was like, all right, it keeps going up. What am I missing? Like, why am I wrong? And so I kind of fell down the rabbit hole and just really took a couple days to watch a bunch of YouTubes, read a lot of articles, and really try to figure out what was this technology. And after kind of that week or so, I was pretty convinced that this technology was going to be around. So I bought some. Unfortunately, it was kind of coinciding with the Pico top. But the biggest thing for me was sticking around. I was pretty convinced at that point of time that smart contracts were going to be here, even though they're at that point in time primarily just used for ICOs on Ethereum. I was really excited about the promise of the technology and kept with it through 2018, 2019, and then kind of once 2020 started happening again. At that point in time, I was at Tesla. I was running the global supercharging network on the software side and really excited about all the things that were going on with composability. Kind of between Tesla doing well and crypto starting to do well again, I decided to go full time.
All right, interesting. So from overseeing supercharged software stack, you jumped into a supercharged crypto market, let's call it this way. Yep. And now you run Frictionless Capital, which is I would call it an early stage investment firm. And I've been going through your Substack blog, and there's some pretty interesting pieces there. Some very interesting takes that you have regarding legacy blockchains, monolithic designs, L2s. So let's just jump straight into the hot stuff. And I'm going to ask you now, what is frictionless thesis? As I assume that it is basically your thesis and also your co-founder's one. Very curious to know more about.
Yeah, happy to share more. So the reason I kept with the blockchain industry after 2018, when ETH fell like 95%, most of the kind of altcoins of the day were now 99%, was primarily the fact that I would say two things: that we could actually have kind of this global financial system, much of that today, at least in the form of kind of being able to contribute to the largest market, which is the US markets. Many people are kind of not allowed to do so. And then being able to, the other thing that really excited me was more holistically kind of composability and the fact that applications could kind of stack upon each other similar to Legos. Those two things just got me super excited because if you can kind of permissionally stack applications one on top of each other, you really have a hard time competing against like individually siloed companies. So when I was at Tesla, we worked extremely, extremely hard. We had many long hours, 80 plus hours a week, and we're kind of in the trenches. But what I realized is that the composability nature of blockchains really just supercharged that. And even Tesla and how much they worked really could not compete with the composable nature. And so I would say more broadly, our focus at Frictionless is really how do you onboard the billion people plus, the multiple billions of people that use the internet every day into the blockchain ecosystem. And so kind of from my product background, I got super deep into some of the analytics being pulled on chain, big fan of doing analytics and the dashboards that they have. And so I started really looking about how many people are actually using these blockchains. And so when I found some Dune Analytics dashboards on like OpenSea and Uniswap, both of them really had less than 5 million lifetime active users. And so I was really trying to figure out how do we accelerate that to 50 million, 500 million, 1 billion. And at that point in time, kind of with DeFi summer happening, there was a lot of kind of high gas fees on Ethereum. And so I really wanted to kind of take the Tesla's first principles approach, breaking blockchains down into their most basic assumptions and figuring out how blockchains truly scale. So Frictionless more broadly is focused on just getting people into Web3 and what kind of technology is needed to create that kind of from the most fundamental building blocks.
As simple as that. And I think that the investments that you've done with Frictionless basically reflect that thesis. For now, I believe that you're a supporter of Solana, given the latest piece that you've been pushing. And should I also assume that you're optimistic about other monolithic blockchains, modern ones that are coming up, such as Aptos or Sui?
Yes, I would say largely blockchain agnostic. And our research, I mean, and really like, so after Tesla, I spent just a year working independently as a researcher, trying to identify these core bottlenecks of blockchains. That was kind of my journey that led me into podcasting, because after that year of research, I really felt like I had a unique point of view in the market that not very many people had. And I wanted to be able to talk to people like yourself, a lot of the builders, people building the industry, and kind of compare notes in a sense. And I was lucky or worked hard to be able to do that, and very appreciative of the people that I've gotten to talk to. But we are excited about Solana. We're excited about Sui. We really excited, again, just about the blockchains that will enable mass adoption. And by doing that kind of with low fees and high throughput. Yes. So more technology agnostic, but yeah, we're excited about the blockchains that do have the potential to scale. And I'm happy to get like super deep into that.
We'll get there. We'll get there. So chain agnostic or tech agnostic, let's just say, use the term tech agnostic. You're supporting any solution that enables more users to basically interact with Web3. So systems that offer Web2-like experience that are Web3 systems. Okay, when I've been exploring your publications and listening to, mostly like reading these blog posts, I understand that you're not the biggest fan of Ethereum's agenda when it comes to scaling. You have a very interesting take when it comes to L2s and their drawbacks, the way they're basically trying to solve Ethereum's problems. And I want you basically to introduce your vision of L2s before we actually deep dive into monolithic systems. Would be very curious to debate with you about what you think is actually the problem with this system, basically.
Sure, I can touch on Ethereum and then I'll dive into L2s. So as I said, during 2018, 19, and 2020, I was also kind of working full time at that point in product and didn't have the luxury to really go as deep as I wanted into the blockchain and crypto industry. And at that point in time, I would kind of describe myself as an Ethereum maximalist. I was very pro Ethereum. I loved their vision and ultimately all the research that they were doing, how they were pushing forward the space. And I really admired all the builders and people pushing Ethereum forward. It wasn't really obvious until I think DeFi summer in 2020. And then after that, once NFTs started really taking shape on Ethereum, that gas fees to me kind of became prohibitively expensive, especially using the layer 1 Ethereum, which most L2s at that point had not really gained adoption. And during that time, I personally paid over $1,000 plus to do Uniswaps. And going back to kind of like our initial vision for frictionless, and really what got me excited about this technology is kind of that global decentralized finance, anybody being able to participate in these permissionless networks, and being able to kind of not be able to transact on the chain for the vast majority of the world just felt sad to me. As a product person, I really wanted lots and lots of users and anybody to be able to transact on it. And so it was really kind of the high gas fees that put me off of Ethereum. And so I started doing more research again to like figure out what were the bottlenecks that were kind of causing that. Transitioning to layer 2s, I find them very interesting. They do have some drawbacks. They are, I'd say, at the dumbest level, just either data compression or compute compression. And really what they're trying to do is use that block space as efficiently as possible. So you have a set amount of block space. You can compress that data to use it more efficiently, or you can make more block space with either sharding or bigger blocks. And Ethereum's roadmap is to do both via sharding and then use the data compression for layer 2s. But at the end of the day, whether it's an optimistic or ZK rollup, I just don't think there is going to be enough kind of block space on Ethereum that will allow mass adoption. And so I think with full sharding, they're going to be targeting 1.3 megabytes per second. With proto-dank sharding, or proto-dank sharding, kind of the incremental step, I think they're doing 1 megabyte blobs every 12 seconds that are dedicated specifically to layer 2s. And yeah, I just don't think that's enough block space for the world to be able to use Ethereum. And then when you start to layer on layer 2s, you just have different drawbacks such as isolated applications because you have to keep the state in a specific layer 2. It's harder for engineers and users to go from a different L2 to L2 or L1 to L2. There's just drawbacks, including latency, that I'm just not particularly fond of from a product experience standpoint. So I'm not like, I appreciate Ethereum and the people building on Ethereum, the research that they've done. I think if I had to maybe summarize it, I think they're now just optimizing for the incorrect things in my point of view. And these newer blockchains are optimizing for the correct things that will allow the onboarding of hundreds, millions, and billions of users.
Yeah, I think that changing a legacy system that's been live for like a few years is also a very tricky process without doing a hard fork or totally they're dealing with constraints where they have an existing system and it's very hard to change certain tiles, certain components of that machine. And so I believe that they're trying to compose with this constraint in mind. But that's a very interesting take that you have here, because we are we're proposing new designs for blockchains to propose, let's say, better performance guarantees and even liveness guarantees to some extent, better designs, because Ethereum is hitting this wall, but still Ethereum, despite the fact that it evolves rather slowly, is achieving some progress, some substantial progress when it comes to becoming more scalable or offering a better user experience. I think that there are some EIPs that cover account abstractions. Bridging designs are still very clunky at the moment. A lot of money is being there are a lot of exploits on the existing bridges, and I mean on a few bridges, not existing. That's clumsy to say that, but we're coming up with light client bridges, storage proofs, and I wanted to understand what makes you not optimistic about the ability of the Ethereum community, let's say the Ethereum Nexus, to innovate and overcome these issues. You also mentioned one point that's very interesting. You believe that the base layer, the block space, there wouldn't be enough block space to accommodate. In case of mass adoption, Ethereum's base layer wouldn't be fitting. But how about, for instance, recursive proving from L3 to L2 to L1? I believe that during your exploration process, you've probably been checking out these solutions. And I would really like to understand more in depth, getting more into details about why you're still not like convinced, despite all the different propositions to tackle these issues.
Our thesis really hinges on, we kind of draw similar comparisons to the early days of the internet. I don't think the analogy maps one-to-one, but I think it's kind of directionally correct. Where earlier in the internet, you kind of started with 56K modems. That was relatively limited in what engineers could build. You could not build a YouTube type application on 56K modems. That then transitioned to broadband, and broadband opened the possibilities for what developers could build. Now today, many people that enjoy the internet and modern society now even have access to fiber optics and gigabyte internet. And every time this kind of transition happens, what engineers can do in that type of applications that they can build is just much larger. So when you have fiber optic internet, you can do cloud computing, cloud gaming, and really stream games. And again, that really hinges on extremely low latency to communicate back and forth at high bandwidth and data availability. So going back to like the blockchain industry, a lot of the debates with the Bitcoin ecosystem was, should you increase the amount of blocks or the block size to really make Bitcoin like digital cash? And ultimately, kind of the small blockers won for a variety of reasons, but that was a design decision to keep the amount of data small. That then transitioned to the innovation of Ethereum and building smart contracts. Ethereum, again, kind of kept a lot of the similar properties as Bitcoin, keeping like the hardware kind of relatively small, but allowed engineers to build applications. It is our belief that these next generation blockchains will enable kind of a larger sandbox for these engineers to build more interesting applications that were just not previously possible. So going back to like Ethereum and layer 2s and even layer 3s, you have to really think about it in the terms of what does the developer experience look like and what is the impact on users. So coming from that product background, like I really think about what are we asking the everyday person that is now used to kind of these very low latency Web 2 like experiences to do in Web 3. And if we're asking them to say start on a layer 1 and then bridge to a layer 2, that may be a cumbersome process. And maybe you could mitigate that by going from an exchange to immediately starting out on a layer 2. And that would help. But then you have one application on a layer 2 that is more DeFi oriented, but on another layer 2, you have games. And so you need to bridge from that layer 2 to another layer 2. And then maybe some of the items or money that is on one layer 2 does not carry over to this other layer 2. And then we're saying, okay, wait, if you want actually even more throughput and more scalability, let's go to a layer 3. And that will only come down to a layer 2. And so just like from the product, from the user perspective alone, there's a lot of nuances that we're asking from the user to understand and know about. But really, when the internet started to gain a lot of traction is when the engineers abstracted these complexities so that it was almost seamless to the end user. So today, many people don't know what an IP address is. They just know the domain name, but the domain name maps to the IP address and then connects to the servers. And I think like as much as engineers can abstract these complexities, that they should. And to the point on like, again, layer 2s, they're not exclusively limited to Ethereum only. Again, they're really limited about block space. So going back to like Ethereum and some of the upgrades that they're going to be doing, once you have full sharding, it's going to be 32 megabyte size blocks, but those are being on the Ethereum network going to happen every 12 seconds. That turns into 1.3 megabytes per second. So you have 1.3 megabytes that you can do for data compression on the layer 1. Other blockchains, these next generation blockchains, are going to be propagating and already are propagating 100 times amount of data that Ethereum 2 with full sharding is going to do. And if you wanted to do a layer 2 on these blockchains as well, you have the same amount of benefits. And so when I start to think about all these things, I think Ethereum had a lot of innovations. They've done an amazing amount of research, and they will most likely probably still do well in the future. But these next generation blockchains will uniquely enable applications and reduce the complexities on the end user. And so that's why I'm very excited about these newer blockchains coming to light, because overall the complexity is reduced and engineers can build more interesting things.
Very interesting take. Super cool. I think that if layer 2s actually do exist, and that there are quite a few of them and different approaches to build these layer 2s, optimistic ones, validity proof ones, etc., is that I think that what people are looking for is, I think one of the most important thing is security. Like they're looking for this economical security, and I think they're looking to be bound to a network that has some kind of almost credible neutrality. And aside from Bitcoin, there are some debates around Ethereum, but Bitcoin and Ethereum are, let's say, the best candidates to have that quality. And beyond that, you want the best liveness guarantees, even though I think most of the other alt L1s, not only Solana, and even L2s are experiencing difficulties. I think that a lot are actually looking to have a system that's highly available to port their business logic and be sure that their liquidation engine will not be compromised by a downtime of the blockchain, which would have critical consequences should you have billions of dollars on that system. I think that this concept of credible neutrality is what really makes Ethereum stand out and is very hard to craft, to replicate in an emerging layer 1, because they're built in a context that puts them in a position that makes it hard for those to achieve this credible neutrality. What do you think about that?
I think it's a valid concern. I think going back to kind of the engineering point of view that like a lot of my research has stemmed from is how does that actually manifest itself? So there's one thing to say like decentralization or credible neutrality, and then there's another thing to say how do we actually quantify that and do like an apples to apples comparison across networks. And again, like really all my research has been trying to boil down to how do we compare networks in an apples to apples comparison across the board. So we can objectively look at these things and try to remain unbiased as possible and just say this network is doing this and this network is doing this. So on the decentralization front, the best thing that I have found today, and if anybody has anything else, I'm happy to look at it and review. But the best thing that I have found today is 2 individual metrics. You could add a couple more, but these I would argue are the main 2, is the number of full nodes in the network. And why this is important is because as long as one independent copy of that network exists, then the network can be recovered. So in case of World War III, as long as one Bitcoin node exists or one Ethereum node exists, that copy of the entire state can be recovered. And so the number of independent copies of full nodes is extremely important. On the Ethereum standpoint, it's a little fuzzy. I look at different sites and they kind of report different things. And what I've seen is between 6,000 and 9,000 full nodes. And there's the distinction between like staking and full nodes, and it's important. So on the Ethereum, since proof of stake, it's between 6,000 and 9,000 is what I've seen. On Solana, for example, there is about 3,300 full nodes, and that includes RPCs. The RPCs on Solana also count as full nodes. So again, it's not as decentralized, but Ethereum kind of has a head start going towards being around much longer, and Solana, I believe, ultimately will catch up and be as decentralized as Ethereum. The other big thing that actually affects the network from a performance standpoint is stake distribution. And how kind of the word that is being used now is the Nakamoto coefficient. So the number of independent parties that would need to collude based off stake weight to start censoring transactions. And in proof of stake blockchains that manifest itself into if nodes can achieve greater than 33%, you can start censoring transaction on the network. If you can get to 66%, then you pretty much have total control over the network. And so the super minority is that number of independent parties that would need to collude to ultimately hit that 33% threshold. And there's some debate about this, but because Ethereum has moved to proof of stake, the main two entities that now control majority of the stake of Ethereum are Coinbase and Lido. You could maybe break those apart where Lido has different entities underneath. And I think I've seen some reports to that where it's around maybe 12 independent parties, 12 or 14. But to me, like, you're still under a same staking provider, so it gets a little fuzzy in that point. And so 12 or 14 independent parties would need to collude to start censoring some of those Ethereum transactions. Solana today actually has the highest Nakamoto coefficient, at least that, and I think followed by AVAX, or sometimes they flip-flop each other, around 30 independent parties. And we've actually written quite extensively about this. I would say earlier you mentioned that we do care a lot about users, but they still have to keep the properties of censorship resistance and decentralization. They can't just be like AWS. That won't work. So you have to have a large number of full nodes, and you have to have a very high Nakamoto coefficient, so a high degree of independent parties, ultimately thousands of independent parties to reach that 33% stake. A lot of blockchains, just because proof of stake is relatively new in the industry, have very low, but we're pretty confident over time both of these numbers will increase. But those are two concrete metrics of like credible neutrality for blockchains more holistically.
I think that the way stake is distributed on the network and the data that you can see on an arbitrary explorer, I'm not saying that foundations actually do that, but it's something that you can, especially in DPoS, it's something that you can forge. That is to say that when it comes to Nakamoto coefficient, you can basically split the stake across new wallets that look like unrelated to each other through some magic rewiring, and you can have a network that looks, at first glance, that looks better from a Nakamoto coefficient standpoint. So I also think that we have to be careful about that. And I totally agree with you with your concerns when it comes to Lido and Coinbase. If there's collusion between both, we can have an issue. Of course, Lido has an agenda for decentralization, involving more and more staking provider and operators to run the infrastructure, but this will take time. And there is always this issue, there's this problem with trust. Is it actually implemented the way it is actually announced and everything? So this is definitely interesting, but there's also some exciting technology that we see on Ethereum. Like, I don't know if you've heard about it, like distributed validator technology.
Like any specifics on it?
You can basically have trust minimized staking, and you can have multiple operators that run the same validator. You can basically fragment that key and, let's say, into multiple shards and have multiple parties involved into running one validator. And you can think of all sorts of combinations. I think that's an interesting kind of technology that we're seeing on Ethereum. I believe that it might eventually arrive on some other networks. But yeah, there are also some solutions that are brought up to better decentralize the infrastructure. But anyway, this is a very interesting debate. There's one thing about Solana and I would love to explore a bit more. You've been publishing recently an article about an optimistic case for Solana and the good points for this network. Let's put it this way. Solana is pretty cool because it scales with hardware and bandwidth. And so the more bandwidth you have, the more messages you can spread. And the more GPUs you have, the more stuff you can execute concurrently. And the thing should scale theoretically. But at the same time, on Solana, you also have important requirements to run a validator or an RPC endpoints. And I know that they're looking at, they're going to ship something called Diet clients, and there's some path to explore to correct this, but it's still like kind of hard to get involved with that chain. It requires quite some good hardware. And I wanted to know what's your take on this, on Solana, and how do you see this system evolving over the next few months?
So let me talk about nodes, and then I'll talk about like Solana and why we like it. With
Sure.
nodes more broadly, it's been interesting. I mean, even going back to like the Bitcoin debate, like one of the reasons why they didn't want to increase the block size to try to make Bitcoin more digital cash-like was because that would increase the hardware requirements. So they purposely kept those hardware requirements small. Ethereum, over time, the goal was to run Ethereum on a laptop. And then as the network increased in adoption, they increased the gas limits and made bigger blocks. And when you increase the gas limits and have bigger blocks, it does require more hardware. And so I think right now today, Ethereum's nodes to run a full node is like maybe just say on like $1,000. And that has kind of increased steadily or a couple times in history. It's interesting now because there's kind of been an ideology line drawn in the sand per se, and saying like this parameter that we have chosen is the correct one, and no other parameters are now okay to explore. And I think that's just like intellectually wrong. I think we should explore those different trade-offs and saying, what if we increase hardware from 1,000 to say 4,000, which I believe on average is what it costs to like actually buy the hardware for a Solana node and run it.
Yeah.
Do you get a 4x increase, or can you get say a 1,000x increase or 100x increase? And if you actually get say a 100x or a 1,000x in the performance increase, is that trade-off worth it from the hardware standpoint? And that is kind of the point of view that Solana has taken. That Solana, by having a little bit higher hardware requirements in terms of costs, can actually have much, much higher performance than Ethereum. And what's interesting about that, and as you mentioned, how we kind of define next generation blockchains is the ability to scale with bandwidth and with hardware. So there's two big kind of misconceptions with this. I would say the biggest one ultimately is Moore's law is dying, which is true in some regards. The number of individual transistors that you can fit on a single chip is slowing down, and we're kind of reaching kind of the physics of how many transistors you can actually put on a single chip. And what we have done, and the industry has done to mitigate that, is essentially add more chips or more cores to the chips. So you can start to parallelize things, and you have to rewrite the software to take advantage of how these chips are now being designed. But this has kind of been a practice that's been going on for quite some time in the computer industry more broadly. You add additional cores. As you add additional cores, you write the software to take advantage of additional parallelism. And so what was interesting about Solana is that they kind of noted that you will have additional cores. And if the software is written in such a way, specifically on the virtual machine side, that if you can do parallelism, then you could take advantage of how modern computers are designed. The Ethereum design for the virtual machine, and ultimately how the main thing that powers the blockchain is the EVM. The EVM is doing single threaded, which just means every transaction has to happen sequentially, one after another. Even if those two pieces of state do not touch the same thing, it does not matter. They have to happen one after another, which severely limits the overall throughput and is not designed for modern hardware. Solana has taken the approach where you can have the parallelism, and if two smart contracts do not overlap or are not trying to write to the same piece of state, those can be executed simultaneously. They don't have to wait for one after another. We think this is a massive unlock for performance, but the other additional unlocking here is that you get localized fees, which we think is very important. We saw that during NFT madness, if an NFT mint was happening, it would spike global fees for everybody. But when you can do localized fees, and this has to happen on a parallelized blockchain, with those fees only spike for that individual contract. So if I'm sending money from me to you, Sam, that transaction would be very cheap, and only that specific NFT contract would get bid up. So that was one component. The other component is just bandwidth on average doubles every 2 years. And we expect that to definitely continue. So if you know that cores continue and the amount of bandwidth that can be propagated continues, it makes sense in our mind to write the software to take advantage of that, because our hardware is not static. our bandwidth is not static. And those are kind of like some of the two main constraints that bottleneck blockchains today. And if you can take advantage of or know that both of those are going to increase, it makes sense in our mind to write the software to take advantage of those.
It's actually very interesting that Ethereum was built with a single threaded design for its VM. I think it was live in 2016 or 17. And back then there were multi-threaded applications were very common. Games were running on quad cores or 8-core CPUs. And this having workloads being parallel processed was a common thing. And it's interesting to see that optimistic parallelism or VMs like C-level came out in production only in 2020, like 2021 maybe for some others. And yeah, changing that component and having parallel execution on the EVM could definitely yield better performances. And I believe that the Cairo VM is being rebuilt in Rust from Python, and they are actually measuring like tenfolds, 20x theoretical performance increase. We could talk about the displayed performances of blockchain, the academical number that you have on the paper and what's actually happening in production. But there's quite an improvement that can also be achieved by recoding the different stacks of a blockchain, of a system. So yeah, leveraging parallel computing is definitely something that gives quite a strong advantage to Solana against other blockchains and of course Ethereum. But there's also the liveness issue that we've had. Of course, there's Quick, there's QoS, there are different updates that are being pushed in order to mitigate, to have this not happen again. But let's say that I'm a builder and I'm willing to build on Solana, and there's still, that record, these incidents that actually happen, sometimes for different reasons. Sometimes it's DDoS, sometimes it's the configuration of one validator that stalls the rest of the blockchain, or maybe I'm approximate on this, but I think something like that happened. I think it's hard from that point also to rebuild confidence and to have people build their application knowing that it could eventually fail at some point, especially for high frequency trading engine or derivatives platform or platforms that involve
I do agree. And this was ultimately one of the reasons why we wanted to write our recent article on kind of Solana and fighting the FUD. And I think the worst month in Solana's history, it had 96-point-something% uptime. And I don't want to say 96% is good. It is not. Really, ultimately, for any blockchain, you want 99.999 repeating. And it is unfortunate that the events that ultimately led to that. I think the biggest thing that I've learned from kind of watching the Solana ecosystem is how important a second client is. And so Ethereum has multiple clients. So being able to have that redundancy is extremely important. There's actually been numerous times in Ethereum's history where one client actually had an issue, but the redundancy of clients allowed it to stay up. And as it stands today, Solana has one client. And if that one client has any bugs, that will ultimately bring down the network. And so that was kind of the impetus for the second client being built. It's called Firedancer, being built by Jump Trading. And they're really going for performance. Today, Solana's Turbine, kind of their data propagation, is rated for up to 1 gigabyte per second. It is not doing that today, but it has the capacity up for 1 gigabyte per second. The Jump Firedancer client, the second client for Solana, target is 10 gigabits per second. And to put that into context, Ethereum with fully shipped sharding is going to be doing 1.3 megabytes. There's over 1,000 megabytes and 1 gigabyte. So it's over 10,000 times the performance increase on just like a purely raw metric standpoint.
Yeah, it's a bigger number against a small.
It is a big number.
Or a big number against small number, but still, we need to see how this fares in production and how stable it is. But that's actually something very exciting because that will make Solana, I guess, the second system after Ethereum with client diversity. That's quite a step forward. I wanted to also ask you about. I've seen that you've been moderating some panels about Avalanche message passing system or Warp, something like this. I wanted to know what you think of Avalanche. What I like is that they have this probabilistic consensus, and
That's cool.
Still curious to know what you think about it, because one shard or one subnet still that doesn't scale much. But I think that you can have a custom VM on the subnet. You just need to build it.
Yes.
Anyway,
So,
curious to have your take on that.
I initially met the Avalanche team at their first conference in Spain. I was lucky to meet Kevin, who is the COO and one of the authors on the white paper. And him and I did the podcast. I learned a lot about Avalanche. The thing that interested me about Avalanche the most was that ability to have any subnet kind of have a custom virtual machine. I think in my mind, it's almost inevitable that all new virtual machines will be parallel processing just so they can take advantage of that modern hardware and multiple cores to access the parallelism. As of today, I don't believe there are any Avalanche VMs that do that. So I'm watching for them, but it is possible from a technology standpoint. But to back up a little bit, I think both subnets and like Cosmos zones are very interesting in the point of view that you can customize the stack. And why I thought that was interesting is because really what I thought both Avalanche and Cosmos were going to really unfold into is kind of like sector specific blockchains. So like a DeFi chain, a gaming chain. And why that kind of sector specific is important instead of just like a single app is because you have that composability nature. Today, composability is really not well utilized. And I think the best kind of example of this was really DeFi Summer. Applications just kind of stacking on top of each other and leveraging the existing infrastructures that other have built. Today, it's relatively small and not very many people are using it, but I fully expect this to kind of become more commonplace as we move forward. And the sector specific, being able to tailor aspects of the blockchain to either have lower finality, change any of the networking layer, that becomes super interesting to me. And both Cosmos and Avalanche have the possibility to do so.
Yeah, I think that's definitely interesting. And to bounce back to the whole L2 thing, I think that the main issue that we have now, but only now, is that you have asynchronous messaging between all these layers with trust assumptions, and sometimes it doesn't work and it works. And as you said, that kills the experience for developers, and that comes with a set of issues. But I think that now we're seeing some breakthrough with storage proofs and zero knowledge proofs, and you have the ZK bridges that are coming up, and I think you can have a smart contract reading like L1 state on L2 or L2 on L1 on L3, etc. in a totally synchronous way, and that also enables rollups to pretty much be to some extent composable, as would Cosmos Zone be or a subnet be. So at the end of the day, it's just going to be very interesting to see which stack, which community, which network has the best, let's say, effect, federates the most developers and users. And I always like that analogy between blockchains and civilizations. There's some guy called Guilty Gyoza that called it civilizational computing, and I think that it is in a way some form of civilizational computing. And in a way, a blockchain, you can't build on it because of the existing infrastructure on it, the tax that you have on it, whether it is MEV or tax at the protocol level or other things, the amount of subventions that you can get from the foundations or the VCs that exist on that chain. And it just it's very similar to I guess, investment in a macroeconomical context. Like you choose a country and you have to deal with all these advantages or constraints. And I wonder if we're going to have a world where Ethereum is pretty much like the US of what we have in the current economy, or and then like you would have other alt L1s or systems like Cosmos or different subnets leveraging Avalanche stack. What would be your take on that? What kind of distribution do you foresee between Ethereum with its first mover advantage as a programmable money system and other players? Do you think it's going to be evenly distributed?
I think a lot of people over the long term believe that there will be like thousands of blockchains and thousands of app chains, and they'll all be kind of doing their own individual thing. I do not believe that. I think there will be a very small handful of blockchains, and those will kind of accrue majority of the value. I personally believe that Ethereum will kind of further down the line no longer be the dominant smart contract platform. And that, again, is primarily because I think they're not totally optimizing for the correct things that will allow onboarding of hundreds of millions and billions of users. The system will work. It will have L2s. You can even do L3s. But I think that design that they're going for will be more cumbersome than newer designs coming to light. Those newer designs can kind of be equal in terms of full nodes or greater, and can have a larger stake distribution so that you have a equal to or greater than higher Nakamoto coefficient as it exists today. Because there are technology limitations to, like, even if you have like the ZK where you can communicate from one to another, and it's a little bit more seamless, at the end of the day, you still have the technology limitations of going from one to another that introduces real world latency. There's no way around like that actual latency aspect. And one thing that has kind of, as it's been explained to me, and that makes a lot of sense, is every year a new iPhone comes out and say it's 20% faster. And if you actually go back to an old phone, once you start using the new phone, it's noticeably different in the terms of how it feels and how you use applications. And I fully expect latency and continued high throughput to enable these next generation of applications to, the lower the latency and the higher the throughput, the more people will use it. And over time, I think people will come accustomed to it. And so I personally do not believe that Ethereum will be the main smart contract platform over the long term, just because of the design decisions that they have optimized for. It will still be relevant, but I don't think it will be the dominant player in my point of view.
You can have its rollups that might eventually offer different parameters. Of course, you're still bound for finality to the L1 block time, but you can have very responsive experiences for games built on L2, even though you don't have complete finality.
Yeah, with the L2, like, it has to be able to essentially fail at any time and be final on the L1. Definitely in that case, the zero knowledge rollups with the instant finality are much better. But the transaction is never final until it reaches that end layer one state. And then even with like sequencers, that's kind of a whole nother topic. How many sequencers do you need? How are you doing sequencer distribution? We could talk a lot about that as well. But there's just different problems that I foresee. It's not necessarily bad. Again, they're all just different trade-offs. And I think what's interesting now that we kind of are going into 2023, the design space of these blockchains has largely been explored. We have kind of the sharding roadmap with Ethereum and Near. We have modular designs with like Celestia. There's a new kind of category emerging with like the middleware with EigenLayer. We have the monolithic design with Sui and Solana. It will be interesting to me to kind of continue to watch it over time, but I think the blockchains that minimize kind of the friction for users and developers, combined with a high degree of censorship resistance and a large number of full nodes, I think will ultimately be the winner. Today, there's still not very many engineers if you compare it to even, say, Google. Google has, I think, over 50 to 100,000 engineers. There's maybe a tenth of that in the entire blockchain industry. So in the grand scheme of things, we're still very early on the user metrics. There's less than 5 million ever using the most popular dApps on Ethereum. It's early. So I would say that the winner has not been decided in my point of view.
Yeah, we're still very, very early. And there's also the question about the purpose of blockchain. To want it to be a price discovery engine, you would ideally need very low latency and very cheap transaction fees in order to perform all sorts of operations like market making or whatsoever. Or do you want it to be a blockchain for transactions that require high security, like, for instance, updating transferring a deed or something like that of a very high value, and you would want it to be on on a blockchain with better guarantees. That's definitely a big debate. Anyway, there's another and last innovation that I wanted to discuss with you. It's account abstraction, which I think should come partially with the IP 4337, and that already exists on some blockchains and L2. That's definitely something that's very exciting because you can have session keys, and you can basically play a game or do multiple. You can have anything that basically signs for you, provided you granted the permission to do so, or an arbitrary condition that enables signing without you doing something mechanically. And I wanted to know what's your take on this. I think that this improvement can also be something that gets us closer to Web2 like experience on blockchains.
Yeah, I definitely agree. I mean, if you look back, I think the largest bottlenecks have been one, just kind of onboarding into the exchanges, two, keeping and having safeguarding your private key if you decide to interact with these apps, and kind of self-custody. That's a huge issue. And then the last thing I would say is just like general like gas fees. And so if you can abstract and really simplify the private key management and make it easier and have different accounts sign on your behalf, there's a world that opens up. And I think this is something that I'm very excited for 2023, is continuously seeing these engineers make it easier for users. And I think that, like, going back to like our core thesis, we want high decentralization. We want high Nakamoto coefficient, but we also want high users, and we want very low friction. And so, and more broadly, anything that kind of enables these to be brought to the masses is something that we're very excited about.
Okay, pretty cool. And any other things that you want to give a shout out to, any kind of project or any other technology that you're excited about? It's another way to put it.
Just my advice to builders today, it's a little unfortunate, in my opinion, that you have to choose between these different blockchains, and you're kind of can be limited by, if you find some type of product market fit, that you're limited by the scalability of the network. So I personally would just say, like, for people that are interested in the industry, really do some research on like going and like learning about the different ecosystems and what they're trying to provide, because it will have large effects down the road. But yeah, more broadly, I would say don't hesitate to jump in. I spent some time and didn't know how to kind of talk to people after that research period and started a podcast. But any way that you can contribute and add value, you'll definitely be welcomed with open arms. I think if you take anything from like this podcast, it's that we are still very early. There's not very many users. There's not very many engineers compared to Web2. And that the space is still very green. There's a lot of things that can be built and things that need to be built to actually enable this mass adoption. And more broadly, this is what we are really excited about for at Frictionless, and the people that we want to partner with. Developers that can build applications that can actually scale to hundreds of millions and billions of users, and people using this technology, because it really is, I think, the coolest thing happening in tech. It just needs to scale. And once it scales, it will be a very cool thing to see people have self-custody of their digital assets and their digital identities. And that's a future that I want to be a part of.
That wraps up amazingly this first podcast we've done together. And I believe there'll be probably a second episode, as I barely covered all the topics that I wanted to explore on this episode. But it's really been cool to have you on. Thank you. And as usual, if you want to engage with Logan or read more about what Frictionless is doing or the blog, you'll find all the relevant resources in the description below. And of course, feel free to ask your questions in the comment section. And Logan, thank you so much for being on the pod, and I hope to see you again.
Yeah, and thank you so much, Sam. Really appreciate you. Appreciate what you're doing for the community, educating people. It's very difficult to do, and so I appreciate the work that you're doing here. And again, apologize for the technical difficulties, but yeah.
It's okay. And I return you the compliment. I mean, it's an amazing podcast, and I totally forgot to invite you guys to also check out Logan's channel, which has I think like a few dozens of podcasts with some brilliant minds. And it's definitely one of one of the podcasts that I watch regularly. So
Well, I appreciate it.
I can vouch for it.
Thank you, Sam.
Thank you, Logan. Thank you to everyone, subscribers, viewers, and see you soon, guys.